of course, helped the market in
Yes.
terms of not just boost or even regulating the market and helping the consumers, Indian home buyers. And when it comes to finance investment, we have seen now SEBI is also learning and evolving and creating good, compliance and regulations to make sure uh, things are going in the right direction. So when it comes to domestic market, as you are emphasizing on this, what do you believe the government should or the SEBI should look into making sure this particular market, the kind of regulations or the kind of suggestions would help to this market to get that kind of bandwidth or that kind of platform.
Right. So I think I must say there is a lot that is already kind of going on. So you have to give credit to our regulators that at some level, and over the last 4 or 5 years, there's an enormous amount of financial innovation going on, especially led by fintechs and all that stuff, and a lot of products that were not available to general public. They were only in the purview of ultra HNIs or wealth managed clients, are starting to come to a more retail kind of investor base. And I must say that I think SEBI in that sense has been active in terms of seeing these trends, analyzing these trends, and bringing a framework. So let's say, for example, because of fractional ownership, they have brought this micro and a small format REIT kind of a framework, right? They have brought that. They have brought OBPP regulations, which is online bond platform regulations, right? So they brought those things in there. REITs actually has been a very good regulation. I mean, in most countries, REIT regulations have taken years and years to get stabilized. But in our case, I mean, they're not very old as a regulation, and a lot of industry consultation needed to be done. But then we are now seeing that action happening, right? All of these things are financialization of real estate, which I think is the key trend, right? So, to our mind, the only other thing is because these spaces are still very new, because our bond markets are not very developed, uh, more than the regulation itself, it is the approach to application of the regulation and the consultative process that is required between the regulator and the market participants. That needs to be more robust. It needs to be a little bit more trust driven, and allow some flexibility, some experiments to happen, have a consultative approach, and change that. Not to say that it's kind of not there, but that is what will be required. If that goes missing, some of these innovations will not happen, they will stifle. So
No,
that's
kudos to SEBI is the kind of proactively they are taking initiatives and coming with regulations. Recently, they pointed out how fintech influencers should be
yes,
regularized, and they're still
right,
working on that,
right,
which is very important. And my
right,
question to you on this line is: we are seeing youngsters,
right,
following this social media, Instagram and
right,
YouTube, and following these certain influencers and doing their kind of bets or the investment based on
right,
what these
right,
particular fintech influencers are saying.
right,
And slowly we might even see in real estate, there be
right,
young influencers coming in
right,
suggesting, you
right,
need to not put money in this particular project or you need not to
yeah,
invest in REIT or something like
yeah.
this. So when it comes to this kind of platform, what is your take? Like, how do we make sure that investors, even the young
Yes,
investors, are not getting influenced with the wrong information, are not making the wrong bets, and are, of course, not going into I would say it will be like a black hole of
yes,
spending money like that.
yeah.
What is your take on this?
No, I think that's a very relevant point again, and that's where I think the biggest trap lies. And so really, you have mature products like mutual funds, FDs, and all that. Even in those, I think people need to apply some judgment. Okay, which is a good fund house? There are some more reputed fund houses. Even with FDs, we have seen problems. Banks have gone down, and again, I mean, strong regulatory framework by and large has ensured that a depositor money has not been lost. But we have seen those instances also, and not in very uh, in fairly recent history, right? So at some level, if you are an investor, you got to educate yourself. Like SEBI is there and regulators are there to do their job, but you have to educate yourself to a certain extent. That's point number one. Point number two is when it comes to newer products, right, or newer spaces. Our space is also a new space, especially, right? I think the most important thing are two. One is, and this is what I personally do, like if I'm myself not an expert in an area, but that interests me from an investing point of view, I really want to look at what is the team behind it. How experienced is that team? Is that a uh, well created team with a lot of experience? They've gone through the cycles, this, that, etc. Right? At the end of the day, that's very important. And the second thing is, what is the alignment? Right? Is this just a recommendation platform? Is there own money involved? What is it? Right? So, or if it is still only a recommendation based platform, then what is the history? Like, whosoever is doing that, for that person, his own reputation has to be very, very important, and he must be in that kind of a business for many years and all that stuff. So, I think investing, there is no shortcut. You've got to look at these two, three things. Don't get carried away with the savviness of the interface, and that is hygiene to my view, right? The real thing lies under the hood, so I think those are the key things that people should look at, and these regulatory frameworks will also ensure that there are certain safeguards that are there anyways.
So, your recent investment in Akasa Premium Residential Project, I want to know what kind of checklist first comes in your mind when you're approaching these kind of projects,
Right.
and how did you finalize to invest in this particular project?
Right. Yeah, so it's like pretty much the same playbook that we kind of use. So I think there are two, three basic guardrails that we always use. First and foremost, we're really looking at the counterparty, or who is the developer, and what is their experience, and what is their reputation in that sense, right? So I mean, these guys have done a lot of work, lot of similar kind of work in that micro market. This was a group called Techno Global and Fortune and Gala, and so they've done a lot of work that gave us comfort. We went, we checked out that work and all that stuff, etc. Right? So that all checks out, right? The bulk of our work is actually doing fairly deep dive into what the approvals are, what the permits are, what the market is, uh, you know, what is the expected cash flow that this project is going to generate vis-a-vis our investment. Do we have substantial covers on it, etc.? So this is very standard. There's nothing rocket science in terms of what needs to be done. But yes, the thoroughness with which it needs to be done is what differentiates a good investment from a bad investment, right? We go through a very thorough thing. What we really liked about this situation was there was a counterparty which is fairly experienced in what we were investing into. They've put in a lot of their own money. Most of our money was going for development of the project. So the exposure was increasing as and when we make that investment. And fantastic, absolutely fantastic location. I mean, it's like stone throw away from the upcoming Ritz Carlton, the 360 West project, very close to the hub of all the new connectivity. Coastal Road is there, Worli Sea Link is there, and all we have to do is about 50 apartments, right? And it provided about a 3x cover on our investment. So so as a combination, this whole package looked quite interesting to us. I think we could generate 15% IRR investment on this for potential investors on earners. So we kind of like that, and that's what that's what we like. And all the regulatory stuff was in place.
Yeah, I was going to ask that.
Yeah.
You must be making sure that
Yeah.
RERA approvals and the overall
Yes.
compliance, everything
Yes.
is being
Yes.
followed.
Yes. Yes.
So I want to know, when it comes to such investment, how are you making, micromanaging this investment? How are
Yeah.
you making sure
Yeah.
the investment is going in the right direction?
That's right. Actually, that's yeah. So again, I mean, so all these investments come with a fair amount of control and ongoing monitoring. So so as a process on any investment that we make two external independent monitors. One on the technical side that is looking through building permits, construction, timeliness of that construction, money being taken from the project is being used to construct the project and all that stuff. So that's an ongoing exercise. And some of the industry leading monitors are the ones that we use. These are the same kind of people I've used during my jobs at KKR and all that stuff, or are being used by other institutional investors, right? So that's one. The second very important aspect of it, and which is also used across the industry by all good quality managers, is escrow controls. So all the money gets channeled through escrow controls, not only RERA but beyond RERA. Whatever releases happens from RERA controlled accounts also happen into other escrow accounts, and from there also whatever flows down further happens through certain bill approval process, right? Ultimately all of that is managed by the trustee, but our team basically works with the trustee to ensure that that support is being provided in that sense. So again, I mean, I must say, while it sounds all easy, it's more than what we do. Then this years and years of experience of doing the exact same thing over and over and over again, that has actually helped us hone our own techniques. And it's really, I mean, the thing is that if you perceive a problem, you need to be able to identify that problem at least 1 year in advance, because then it takes that much of time to ensure that that problem does not derail your investment. And then you start working with the counterparty. Ultimately we are in one way on the same side. He also wants that project to succeed, we also want that project to succeed, and everybody has a happy ending in that sense, right? So that's what we are working towards. And I must say that in most cases, if there is a problem that we identify, we are able to work with the counterparties and borrowers to make sure it does not snowball into a problem that's unmanageable. And that has been the reason even some of our historical investments, which were done in a much more worse vintage, where the sector was actually not doing well, residential sales were not good, and capital supply was so much that you were not getting that good risk reward. Today actually we are in a completely opposite environment. So that is the first line of defense in any ways, where I mean 2023 we sold about some 3.8 lakh apartments, which is up from some 2.5 lakh apartments in 2022, which was still a very, very good year. So we have that benefit of a robust cycle and low capital availability, which allows us to have better risk reward. And then we apply all of these principles.
But doesn't this monitoring and micromanaging and all of this, doesn't it miff developers?
It doesn't. I mean, honestly, there also the point is, so first of all, at least we are very clear. We are not there to run their business. They know their business best, right? We are not experts at selling. We are not experts at development. Yes, we have all the agencies who have a lot of expertise in that, but they are there to monitor in that sense. So, incidentally, a lot of seasoned developers, they just understand it. They get it. They know this is the cost of having capital. And idea is to not make it a painful process. Just make it a simple, streamlined process, and for the most part, it just works. So yes, initially when all these things started several years back, it was cumbersome to implement. There were concerns, issues. As investors, we all evolved to understand what's practical, what's not, or how to enforce and implement these monitoring frameworks without actually causing business harm.
No, why I'm asking this because when I spoke to a few developers to gain an insight on what is their take when it comes to AI companies and other companies, they got miffed because of the fact where the companies, investors are telling us, you need to change the website. The website doesn't look that great. It's not gonna get a lot of people coming to the brand. Then they're changing the contractors, then they're bringing their own mandate business agency. But the micro controlling part of all of that is, of course, not setting down good with the developer. They feel like I'm not the developer anymore. It's the investment company or the AI company or any companies that are putting the working capital. It makes them feel that they are just being the puppet and now they have to just go whatever they say.
So, and I agree with, I mean, in the sense, see, if you honestly think about it, there are two kinds of investments. Am I an equity investor or am I a debt investor? Actually, if I'm a debt investor, I'm not even getting paid to do all of that work, right? I am getting paid to make a good investment. I am actually not getting paid to run a development project. And if I partnered with someone who is competent to run the development project, I should not be required to do so. So to my mind, and that has to be an exception rather than your base case. If something has gone wrong, we should absolutely have the ability, and those rights we do retain, to jump in, change contractor, do XYZ and all of that. But that is only when things have gone wrong. Otherwise, I made a bad selection of partner in the first place. So to us, that's very important. Yes, if I'm actually in it, I mean, to give all kudos to Swami Fund, they actually had a mandate to revive projects. And they will be required to do exactly that, because when they are stepping in, these are stuck projects which they are required to revive. So they will have to change the contractor, they will have to change the selling agents, and that's their mandate. But our mandate is very clear. We are not taking anything on Ernest where he is a stuck guy, or he is not performing, or there's a problem. We are not trying to do that. So when I'm not trying to do that, I should not be required to micromanage. I should only be required to monitor. So, I mean, some of those cases could actually be cases where the DNA of the firm is to go into more stressed projects, and they may want to do that. Or it could be situations where things started well, but then they went south and they wanted to do that. So, but I personally don't subscribe to that ideology that the moment we invest, we start running the show, because that's not my job.
I've been hearing this particular part a lot, because this is not going well.
Right.
With, of course, the smaller developers,
Yeah.
the developers were stuck. It's not going well.
Yeah. And I will give you an example from my KKR days. Okay, Earnest business is relatively new. We started last year. But in KKR also, investment that I personally led was almost $700 million there. I don't think there was one project, right, where we necessarily had to go to that point of really trying to run the development. At the very fact, and there were one or two projects where sales were slow. So then we actually actively work with the developer. Okay, what could be the idea? There could be some exchange idea that we brought in, all that stuff, and in consultation with them. So, I mean, honestly, we will do everything that is required to be done to protect our investment if something is not working. I must say that. But at the same time, if we are required to do that, my personal view is we have gone wrong at the outset in selecting the right partner.
Lastly, I want to know, and it's just a hypothetical question, where you're making an investment in such residential properties or in such market, you have spoken about the checklist when you do the thorough research, making sure the compliance radar, everything is followed. But still, if the project gets stuck or if still there's a problem,
Yes.
what kind of exit strategies you make sure that your investors or your stakeholders are not getting affected much in it,
Right.
and you can make a smooth exit from that project?
So yeah, so I think so in general, when you're making an investment only, you've got to provide room for markets to change. You know, in general, we end up underwriting time frames which are at least a year more than what normally it should take in a normal market for us to get out. So it allows us that much time to fix things if something has gone wrong, right? So we already buffer that much in, typically speaking, right? At the same time, honestly, these are risk investments. Something can go wrong. Let's say tomorrow there is a COVID kind of an event happens, which actually stalled everything for 8-9 months. Now that's exactly where I think we buffer this up. That if some events like that happen, COVID was an extreme event, nobody could even, but something other, we hopefully will still be fine, right? At the same time, if we completely get stuck somewhere, we will have to figure out a way as to who is the new capital provider who can bring in. Can we create some other solution? My own view on this has been, if you have done your investment sensibly and it is well covered from a value perspective, thankfully real estate is not a perishable commodity. Even for, let's say, 6-9 months nothing got sold, those houses were still there, right? As opposed to a lot of companies where if the EBITDA is lost or if that production hour is lost, it's just gone. So thankfully we are in that stage. So I always say real estate financing should not be that expensive. At the end of the day, we are giving money against hard assets. They're not going to run away. So first line of defense, you just make sure that you're identifying the problems early on. If they might appear, then you have solved them within time, right? If the value is there and my time is running out, in all likelihood, I will be able to find some other investors to step in and give me an exit. If somewhere we have gone horribly wrong and we assess the value wrong or the business wrong or the partner wrong, honestly, we will suffer, our investors will end up suffering. There is no shortcut to it. right? In that sense, in that scenario, we will try and do whatever best we can do to recover as much value as we can. Of course, we have all the legal rights, the enforcement rights, the mortgage, the pledge, the personal guarantees, all of that is there. But if we are in that stage where we're using them, something has already gone horribly wrong.